Alright, you guys would know this series. It is a new one. It is going over people's portfolios on one of the most interesting places on the entire planet, which is reddit.com. Now, people will post their portfolios on Reddit. This is the series where I basically go over those holdings, share my thoughts. This is a new series, so make sure if you guys like this kind of series, let me know in the comments section, and also hit that like button for me. It greatly helps out the channel. Also, make sure to check out the Dividend Stocks Not Drugs merchandise, the best looking merchandise for any dividend investor. Thank you, and roll the intro.
Hello, I like money.
Alright, our first guy here says, after some aggressive saving, he finally hit 10,000 in his portfolio. First of all, congratulations. To go over the portfolio real quick, he has 12 separate holdings, and he's basically investing for dividend income, it appears. He's on the dividend subreddit. So to start off, 36.8 of his portfolio is in JEPQ. Look here, I'll be completely honest. I don't know this guy's circumstances. He could be in retirement and actually living off this income, but having 36.8% of your portfolio in JEPQ is absolutely insane. And some of the other holdings, it's just a complete mix, and it really hurts my head, to be honest. But once again, I don't understand his situation. If he's honestly younger, he's looking for dividend income. I think over long term, a better way to do this is investing in SCHD. It just makes more sense. And we can see that SCHD is 4.4% of his portfolio. Main Street Capital Corporation is 12.2% of the portfolio. Starbucks, I like this holding a lot, 11.8% of the portfolio. I love that a lot. Love to see more. More realty income, more real estate, 11.6% of the portfolio in realty income. Realty income actually just reported earnings today, and they pretty much were in line. It's what you get with realty income. But I think almost having half of your portfolio in JEPQ is absolutely crazy. Once again, I don't know his situation whatsoever, so I'm not going to harp on him too bad here. But it's just not an effective way long term to be generating dividend income. If he's looking for dividends, if he's, moderately young, he's not like in his 60s or 70s living off this, I would just look at SCHD, to be completely honest. But hey, at least it's not yield max. Alright, looking now, he has Pepsi, which is 3.4% of the portfolio. Vici, which is 3.3% of the portfolio. Alright, I'll say this here. I think it would be way smarter for him to supplement that Main Street Capital Corp or Realty Income and have that money in Vici. We are getting the same exact dividend yield, but you're just getting way more growth potential with it. I'm actually considering selling a good part of my Realty Income and putting it into Vici right now, but the main reason that I'm likely not going to be doing it, I just don't think it would be responsible to be selling Realty Income, a company I know that will be trading in the 60s and 70s again at some point. I think with patience, it will definitely get there. If O gets back into the 40s, I'll be buying as a medium-term holding. I don't like Main Street Capital Corp, and I don't love Realty Income. I think Realty Income is solid, but I think there's just a lot better options, but I really don't like Main Street Capital. I think that's one of those monthly dividend stocks people are buying just because it's monthly. I think you'd be way better off just putting that into Vici. Next, he has Altria, makes up 2.5% of the portfolio. I really like that holding. I think like 2.5% for Altria is a really good weighting for that position, and that's actually where my position in Altria and my portfolio is at right now. It's around that 2.5% range. That's where I'd be comfortable. I think you're going to be getting some solid dividend income, definitely more of a value/recovery play, but you're getting paid to wait. Next, he has Waste Management, which is 1.8% of the portfolio. Obviously, Waste Management's trading at crazy prices right now, over $200 a share. I'd love to see him add to this, but at the right price. Then he has Procter & Gamble, which makes up 1.5% of the portfolio. I think it's a solid company, but once again, not the best if you're a really younger investor and you're investing like for 40, 50, 60 years. Solid option though if you're in your 30s, 40s, 50s. And lastly, he has 3M, which takes up 1.1% of the portfolio. I don't know his case scenario 3M, so I'm not going to speak on it, but I just don't think it's the best option. And I think it's likely they do cut that dividend. If he's investing for a dividend income, I think there's a solid chance, better than not, that 3M does cut that dividend. With my 3M position right now, I think if they were to cut the dividend, it would be the better move for the business overall. I'm still contemplating what to do with my 3M. He also shared his portfolio dividend stats as well. Every month he's getting $52 in dividend income. Right now his dividend yield is 6.33%. His yield on cost is 6.45%. Look, I think if he's a newer investor, he might be falling into the dividend trap a little bit, chasing monthly dividend income, quarterly dividend income, all that stuff. And I think long term, if he's investing for real long term time horizon, I think he could be making a mistake here. If I were him personally, I would sell out of Main Street Capital Corp. I'd put that money all into Vici. You'll be getting solid dividend yield still. Sell out of JEPQ, put 10% of that into SCHD, and put the rest of it into a total market index fund. I truthfully think that would be the best way to go. Yes, he would be losing money in dividend yield. 6.33% is a crazy dividend yield for a portfolio either way. And you'd still be getting dividend growth long term with SCHD, hopefully with some of the rebalances that they're doing as well. So that's what I would personally do with his portfolio. I think JEPQ could be a potential lagger for him and could be holding him back for a while, especially considering that it's nearly half of the portfolio and over 1/3 of the portfolio and weighting. And once again, I think it's really important to mention, with my portfolio review series that I do, I typically know a lot more about the investor, their age, objectives, and I can make a much more better, opinion on these different stocks. Like some people just have different goals with different stocks, and it's, vice versa. But this next guy, Electric Lotus, just hit $1,000 in annual dividends in his brokerage. Congratulations. Start off, the first holding is VU. You cannot go wrong with VU. Next, he owns SPHD, which is Schwab's low volatility dividend ETF. After looking at some of these holdings, I'm going to assume that this guy is probably older in age and looking for dividend income. But again, if you're younger, this is not the way to go. Total returns just by VU. Next, he owns JEPQ, and I kind of shared my thoughts on JEPQ with the last portfolio. Next, SCHD, and I think SCHD is really solid for a lot of people, even if you're young. I think there's dividend growth ahead of it still. Look, with SCHD, there's a lot of slander around it, to be honest. A lot of people are calling it mid, and I'm an investor in SCHD. It makes up about 10% of the portfolio right now, maybe 8 to 9% of mine. Look, if I make an investment for the long term and nothing's changed with my thesis, I still think that there's growth and, income to be held ahead, I'm going to continue holding and let my money compound in that investment. I think for SCHD, it's a really solid alternative for a lot of people, even if you're looking for dividend income. And I'm going to be looking for my dividend income in my 20s. I want to go on vacations, do cocaine, and other fun stuff. Next, he owns Realty Income, then he owns Divo, then he owns JEPI. SCHY, I'm seeing a lot of the same stuff, to be honest, right now, and I think if you were to consolidate into maybe 3 or 4 of the best of those ETFs served for its individual purposes, I think you'd be a lot better off doing that than just buying a whole bunch of the same stuff, just with different tickers and different names. You're paying a whole bunch of different fees as well, and it can get very confusing. Then he owns Main Street Capital Corp. I kind of shared my thoughts on that in the last one. Then he owns Stag, so I mean Main Street Capital and Stag. Let's be honest here, guys. People aren't going to be buying them for the actual business itself. They have a solid business, but they're paying a monthly dividend. That's the reason a lot of people are investing in these kind of stocks. It's wild, man. People just want to see money quicker. A lot of people don't want to see delayed gratification, and a lot of people invest in stocks because they're monthly dividends. Truth is, monthly dividends really kind of sacrifice quality at the end of the day. Then he owns QQQ. I think that's solid, offers some growth in the portfolio. Then he owns Microsoft and Apple, and those are two pretty sizable holdings for him. Lowest in dividend income, but I think total returns, that's going to be his biggest gainers at the end of the day, probably with QQQ and VU. I would look for this guy to consolidate his portfolio for sure. I think he owns a lot of the same stuff under different ticker names. I also like the QQQ exposure and the Microsoft and Apple exposure. So I would just say consolidate some of your stuff and build up on some of the growth stuff, and I think he'll be fine long term. I'm just not a fan of the JEPI and JEPQ. I think those are a lot of dividend yield traps, and also trim down on the monthly dividend companies if you really don't need that money. Alright, appreciate you guys for making the video. If you like this series, let me know in the comment section and by hitting that like button for me. Thank you guys for watching. Check out the Dividend Stats Drugs merchandise. Very nice winter beanies on there. Alright, thank you guys for watching. Smash like, unsubscribe, and Dividend Stats Drugs. Have a good one.